Okay, let's unpack this. When you hear global inflation, what comes to mind? For a long time, we've kind of thought of it as, one big story.
Right, a single trend.
Exactly. But our deep dive today, looking at recent reports from the IMF, World Bank, OECD, well, it reveals something pretty surprising. This idea of a single global inflation narrative. It's now being called analytically obsolete.
Which sounds jargony, but it's a really crucial point.
It really is. So what does that mean for you listening in? Basically, you can't just look at one global average number anymore and think you understand what's happening.
It's like trying to get the weather forecast for your city by looking at the Earth's average temperature.
Exactly. Tells you almost nothing about the local storm, right? So our mission here is to cut through that complexity, pull out the key nuggets from these reports for your strategic outlet.
And that's where it gets really interesting. You're absolutely right. People talk about disinflation globally, but it's stalled. And what's really fascinating is how incredibly different the experiences are underneath that average. We're seeing everything from inflation surging again in some places
to actual deflation in others. Wild contrasts.
Completely wild.
Okay, so to really get into this fragmented picture, let's just quickly make sure we're on the same page with terms. Most of you know this stuff, but just for clarity, inflation, simply put, is a sustained rise in prices. We usually track it with the CPI, right? The Consumer Price Index.
A basket of goods, yeah. What everyday things cost.
And then there's core inflation. Central banks focus on this one a lot.
They do. It strips out the really volatile stuff like food and energy prices to show the underlying trend better.
Gets rid of the noise, basically. And in Europe, they use the HICP, the Harmonized Index, just so they can compare across countries easily.
Standard stuff, but important baseline. Now, if we connect this back, that global average, the IMF's 4.2% projection for 2025, it hides almost everything that matters.
Hides everything.
Yeah. And here's a really striking detail from the OECD data. Across their member countries, average price levels are now, get this, 33.7% higher than they were in December 2019.
Wow, 33.7%.
And a jump like that. Previously, it took about 14 years to happen.
14 years crammed into just a few. Okay.
So this isn't just some temporary blip we're talking about. It's a permanent increase of the cost of living. That 33.7% isn't going away. It's the new baseline for your purchasing power.
That really hits home. Think about your weekly shopping. It's real.
Very real.
But here's where it gets really interesting, I think. The drivers behind this inflation have fundamentally changed. It used to be all about supply shocks, right? Pandemic, wars.
That was the story for a while, yeah.
But now, the big new driver seems to be trade protectionism. Tariffs.
Absolutely. That shifted things significantly. Tariffs are a direct cost-push inflationary force. They just make imported goods and components more expensive.
Can you give an example? Like, how much impact are we seeing?
Well, look at the U.S. The effective tariff rate, what's actually being paid, it jumped from around 2.4% historically to maybe 8-9% now.
That's a big leap.
It is. And it's not just the direct cost. All this uncertainty around trade policy, it acts like a powerful economic depressant, too. Businesses hold back on investment.
Which leads to this central banker's dilemma. How do you steer your own economy when everyone else is doing something different?
Exactly. The paths are diverging sharply.
Take the U.S. Fed. They're holding interest rates high, right? Because they're fighting inflation that's actually reaccelerating, partly due to those tariffs we mentioned. Projections are up to 3.9% by the end of 2025.
But then you look across the Atlantic.
Right. The European Central Bank. Totally different picture. Their HICP inflation is around 1.9%. That's actually below their 2% target.
Gives them much more room to maneuver, potentially cutting rates.
And then there's Japan, cautiously trying to escape decades of deflation. Just completely different worlds.
And this raises an important question, maybe for you, the listener.
Yeah.
How does this policy divergence translate into instability?
Yeah, like currency markets.
Precisely. Sustained volatility there. It shifts import and export costs, changes who's competitive. Big ripples.
Okay. And this brings us to another split. The bifurcated global consumer. That sounds fancy, but it just means a huge imbalance in demand.
It does. In the U.S., you've still got remarkably strong consumer spending despite everything. That creates demand pull inflation. People buying stuff is pulling prices up.
But contrast that with China.
Oh, completely the opposite. China's grappling with actual deflation. Their CPI consumer prices fell 0.1% in the first half of 2025.
Minus 0.1. Wow.
And producer prices, what factories charge, down 3.6%. They're dealing with what reports call disorderly low-price competition. Basically, a price war at home.
That's now spilling out globally.
Exactly. China is effectively exporting deflation now. And that's a major source of instability, catching other economies in this kind of crossfire.
So let's just quickly recap these regional contrasts, make it concrete. U.S. inflation bouncing back up, 2.7% CPI.
Euro area, success, sort of. Disinflation down to 1.9% HICP, below target.
China, deep in deflation, minus 0.1% CPI, exporting it.
But then look at India. Quite remarkable disinflation. CPI down to 2.1%, and their food prices actually contracted by over 1%.
Really different stories. And Russia?
Still battling very high inflation, but 9.4% CPI. Shows how local policy and circumstances really matter now. These aren't small variations.
Not at all. So let's pull this together. What does this all mean for you? What's the strategic outlook here? Well, first, the cumulative hit from inflation has definitely eroded purchasing power. We all feel that.
And it hits lower income households the hardest. Always does. Plus, global growth is slowing down quite a bit. The World Bank's projecting just 2.3% for 2025. That affects jobs, investment, everything.
So the outlook is uncertain.
Definitely uncertain. I think the key strategic takeaway, whether you're an investor or running a business, has to be embrace granularity, reject monoliths. Meaning you can't use a broad brush anymore. You have to tailor strategies region by region, market by market. The old playbook is broken.
So digging into the details is critical.
Absolutely. And another crucial point, focus on building supply chains that are resilient, not just the absolute cheapest. The cheapest might be too fragile now.
That makes sense. And you mentioned China exporting deflation. Is there an opportunity there, like a deflation arbitrage?
Potentially, yes. Businesses might be able to source cheaper goods from China.
And sell them into markets where prices are still rising, boosting their margins.
It's a possibility. It really feels like the old rules of the global economy just don't quite apply the same way anymore.
Yeah, the game has changed.
And navigating these profound differences, these divergences, that's really paramount now.
Okay, so final thought to leave you with. In World War I, huge economy, the U.S., is exporting inflation via demand and tariffs, and another, China, is exporting deflation. How do you think global businesses will actually adapt their pricing strategies over, say, the next 12 months? Something to mull over.